In March 2021, billions of dollars disappeared almost overnight. No major recession triggered the collapse. No global panic filled the headlines. Instead, a little-known investment firm called Archegos Capital imploded so quickly that some of the world's largest banks were left scrambling to contain the damage. Within days, more than $100 billion in market value evaporated across several stocks. Major financial institutions suffered billions in losses. Investors around the world were asking the same question. How could a firm most people had never heard of cause so much destruction? The answer was not fraud, it was leverage. And the collapse revealed how hidden risk can accumulate quietly inside modern financial markets until a single crack exposes everything. Archegos Capital Management was founded by Bill Hwang, a former hedge fund manager with a reputation for aggressive investing. Years earlier, Hwang had run Tiger Asia Management, a hedge fund focused primarily on Asian markets. The firm generated impressive returns, but later became involved in insider trading and market manipulation investigations. After settling with regulators, Hwang transformed his operation into a family office. Unlike traditional hedge funds, family offices manage private wealth rather than outside investor capital. Because of this structure, they often face less regulatory scrutiny and fewer disclosure requirements. Archegos managed billions of dollars and operated largely outside public attention. That anonymity became one of its greatest advantages, and eventually one of its greatest risks. By 2020, Archegos had quietly become one of the most influential investors in several publicly traded companies. Yet few people understood just how large its positions had become. Archegos represented a broader trend in modern finance. Large investors increasingly use leverage to amplify returns. Leverage allows an investor to control assets worth far more than the cash they actually possess. If investments rise in value, profits become significantly larger. For years, this strategy appeared highly effective. Banks were willing to lend, markets were rising, technology companies and media firms attracted enormous investor interest. Archegos concentrated its bets in a relatively small number of stocks. Rather than diversifying broadly, the firm focused heavily on companies it believed had strong upside potential. As markets continued climbing, the strategy looked brilliant. The firm generated substantial gains. Its positions grew larger. Banks became increasingly willing to extend financing. Success reinforced confidence, and confidence encouraged even greater leverage. The system worked perfectly as long as prices continued moving upward. The problem was that the entire structure depended on exactly that. The rise of Archegos was remarkably quiet. Unlike famous hedge funds that regularly appeared in financial media, Archegos operated mostly behind the scenes. Using complex financial instruments known as total return swaps, the firm was able to build massive exposures without directly appearing as a major shareholder in public filings. This allowed Archegos to accumulate enormous positions across several companies while remaining largely invisible. Multiple banks facilitated these trades. Each institution could see its own exposure, but none could see the entire picture. As a result, several banks unknowingly financed similar positions simultaneously. The scale became extraordinary. Through leverage, Archegos controlled tens of billions of dollars worth of securities. The actual capital supporting those positions was only a fraction of the exposure. For a time, everything appeared stable. Stock prices increased, banks collected fees, Archegos generated returns. The arrangement seemed beneficial for everyone involved. But beneath the surface, the system had become extremely fragile. A small decline in asset values could trigger consequences far larger than anyone expected. The collapse began with falling stock prices. Several companies heavily owned by Archegos experienced declines that might normally have attracted little attention. Under ordinary circumstances, these moves would not have been catastrophic. But Archegos was not operating under ordinary circumstances. The firm had borrowed heavily to finance its positions. When prices fell, banks demanded additional collateral through margin calls. Margin calls are straightforward in theory. Investors must provide more capital when losses increase. If they cannot, positions may be liquidated. As Archegos struggled to meet these demands, banks became increasingly concerned. The problem was not simply the decline in prices. The problem was that multiple banks had financed similar exposures. Once selling began, everyone rushed toward the exits simultaneously. And now banks started unloading billions of dollars worth of shares. The market was flooded with supply. Prices fell further. Additional losses triggered additional selling. The cycle accelerated rapidly. Within days, the structure that had taken years to build collapsed. What appeared to be a sophisticated investment operation was revealed to be heavily dependent on leverage in rising asset prices. The losses were staggering. Several major banks suffered billions in damage. One bank in particular would never fully recover from the consequences. The collapse exposed a simple but powerful reality. Risk hidden from public view is still risk. As Archegos unraveled, the damage spread across global financial institutions. Some banks reacted quickly and sold positions aggressively. Others moved more slowly. The difference proved costly. Among the hardest hit was Credit Suisse, which ultimately lost more than $5 billion. Other institutions also reported significant losses, though on a smaller scale. Billions of dollars disappeared within a matter of days, yet no customers were lining up outside banks. No recession had begun. The crisis emerged entirely within financial markets. This made Archegos unusual. It demonstrated that systemic stress can originate not from the broader economy, but from concentrated positions hidden within complex structures. The collapse was fast, violent, and largely invisible until it was already happening. After the collapse, regulators and banks reviewed how family offices were supervised. Questions emerged regarding transparency, leverage, and disclosure requirements. How could one investor build such large exposures without attracting greater scrutiny? Banks tightened risk controls. Some institutions reduced their willingness to extend leverage to similar clients, yet the underlying incentives remained. Leverage still exists, complex financial structures still exist, and competition among banks remains intense. The system adjusted, but it did not fundamentally change. Archegos was not the largest financial collapse in history. It was not even the largest collapse of its decade. What made it important was what it revealed. A single investor, operating largely outside public attention, accumulated enough leverage to inflict billions of dollars in losses on some of the world's largest financial institutions. The collapse demonstrated that risk does not disappear when it becomes harder to see. Sometimes the most dangerous vulnerabilities are the ones hidden behind successful performance, and sometimes a crisis begins long before anyone realizes there is one.